In this video, we will discuss the top stocks to buy for high dividend returns. We adore dividend stocks in this country, yet many of them mislead investors by being high-yield traps that ruin your investment. For example, sample shares of Great Elm Capital, which have a 14 dividend yield. That's not terrible until you consider the company has gone down 65% in the previous 5 years, fully wiping out all the yield as well. Not only is your portfolio destroyed in the fall, but the dividend is also reduced, leaving you with a return that is a quarter about what you imagined. In this video, I'll demonstrate how to choose dividend stocks with the highest yield return and stock price. I'll also teach you how to locate dividend stocks that will boost your investments and put money in your pocket. Finally, I'll show you the 7 dividend stocks I'm looking at right now that have had the best overall yield return over the past 5 years. I want to get straight into our listing of the highest return dividend stocks, so I'll demonstrate to you how I identify them and what to look out for later. I'm putting these in order from lowest total return to highest, so stay with me because the last stock has gone up almost 300% in the last 5 years and ends up paying a 5% dividend yield. Devon Energy, the first dividend stock, has been among my favorites and had the highest yield in the S&P 500 last year. Devon is the biggest oil producer in 3 states, North Dakota, Texas, and Delaware. Since the price of oil has gone up in the last 2 years, these assets are now cash flow machines, and like many companies, Devon is giving that money back to its shareholders instead of buying other assets at such higher prices. Since it merged with WPX last year, its free cash flow has increased by a factor of 4. This year, it expects its cash flow to be even better. At $94 per barrel, which is much less than the current price, the company's free cash flow will grow by 18% this year, and prices may fall to $30 per barrel before the company starts losing money. All of this helped Devon increase its stock buyback plan to $1.6 billion, which is almost 3 times as much as it bought back last year. It also keeps up its history of growing dividends. The dividend yield on the shares is now 8.08%, and the dividend yield over the last 5 years has been 115%. Next on our list of dividend stocks is OneMain Holdings, ticker OMF, which has a 10.22% dividend and is a market leader in consumer loans. Shares of OneMain have dropped over the past year, but the company has been in business for over a century and has served over 2 customers worldwide and made more than $155 billion in loans. The shares have gone down because people are afraid of a recession, but OneMain has an impressive 20% off a market that is worth $500 billion. With the purchase of TriMap, it moved into the financial wellness technology space, which will help it grow in areas other than credit and make it a more diversified business. Management thinks that by 2025, the number of customers will have doubled, and the company's capital will have grown by $1.5 billion. Now that would add to the stock's 115% dividend yield over the last 5 years, which includes dividends of $15 per share. We're just getting warmed up with our ranking of dividend stocks. But one question I frequently receive is why we shouldn't just pick the ones with the highest dividend yields. Investors love to look for stocks with high dividend yields, and a stock that pays a 20% dividend is tough not to be excited about. With a portfolio of just $60,000 and a yield of 20%, you would get a dividend payment of $1,200 every month. The problem is that if you look more closely, you can see that most of those stocks with very high dividends have lost value for investors over those years because their shares have fallen, losing out your investments before they cut their dividends. And there is nothing wrong with wanting a higher dividend, but tracking dividend yield is like walking a tightrope for both high yield and risk. And when it comes to some highest yielding investments, you're going to fall off. The next dividend stock, Broadcom Incorporated, ticker AVGO. With a 3.06% dividend yield, AVGO is one of the few tech stocks that actually puts cash return first. Broadcom is indeed the leader in the microelectronics, semiconductor, and infrastructure industries. It has almost 20,000 patents in its intellectual property portfolio, which includes growth in cybersecurity, renewable energy, automotive, and automation. In spite of problems in the semiconductor distribution chain, the company's revenue has grown at a rate of 10% per year over the past 3 years, reaching $27.5 billion. At the same time, the company's dividend payment has grown at a rate of 43% per year, which is rare for dividend stocks and non-existent for tech stocks. Perhaps the most exciting is that the company just bought VMware for $69 billion to make it a leader in virtualization and the cloud. The company's annual profit will go up by $13 billion right away, and the cloud service market grows at 19% per year. The deal is expected to be completed early next year, and VM stockholders will get $138 per share in cash and stock. VM shares were as high as $170 per share just last year, so I assume Broadcom is receiving an excellent deal. Even better, the company's management thinks it can accomplish this and still keep its promises about dividend growth and share repurchases. In the past 5 years, the company has paid out 50% of its free cash flow as dividends and bought back $10 billion in shares, such as dividend shares, for a total return of 144%. AbbVie Incorporated, which makes drugs and has the ticker symbol ABBV, is one of my favorite dividend stocks. It has a dividend yield of 3.93% and is a fantastic way to secure your portfolio in a crash. Most drug companies do well when the stock market goes down. This is because you need your heart medicine whether the stock market is up or down, and maybe even more when it's down. AbbVie is the best drug company in its field when it comes to immunology. It also has a powerful pipeline in oncology and eye care. Often, these drug pipelines are simple to comprehend on a timeline, but not all. The company has 32 pieces of evidence in phase 3, and sales of Skyrizi and Rinvoq alone are expected to reach $15 billion by 2025. Share prices of AbbVie have had a total return of 157% over the past 5 years, and they are also one of the fastest dividend growers. Over the past 5 years, the dividend has been raised by 18% per year, which has helped investors get a higher yield. We still have 3 more dividend stocks to talk about, but I also want to hear from you. What else do you search for in dividend stocks? Is it just a high yield return, the value, or something else? Let me know. Comment down below. Next stock, The Buckle Incorporated, has the ticker symbol BKE. It has a dividend yield of 4.64% and a total dividend yield of 205% over the past 5 years, even though it has dropped 30% so far this year. The Buckle has nearly 440 stores in 42 states that sell a combination of casual clothing and shoes. It's a retail department area with a market cap of only $1.4 billion, but it still manages to do well. The company recently said that its first quarter sales were up 3.3% from the same time last year to $309.9 million, with about 18% of that coming from online sales. Even though the company's net income had been down 3% from the same time last year to $1.12 per share, it beat estimates by 25% for the quarter. Now, Buckle shares are about twice as expensive as those of its competitors, based on their price-to-sales ratio. However, its operating profit margin of 25% is more than double the market rate. The company's balance sheet is remarkably strong, with only $13 million in net debt. This gives the company all of the financial freedom it needs. Overall, the Buckle is a positive customer discretionary stock to add to your portfolio if you want to get away from the more common dividend stocks. Now, Blackstone Incorporated, with the ticker BX, has a dividend yield of 4.47% and a total return of 247% over the past 5 years. The company is one of the largest diversified asset managers in the world. It has almost $1 trillion in real estate, hedge funds, private equity, and credit assets under its care. I like this one a lot, not just because of the dividend yield and return, but also because it gives investors a chance to see a portion of the financial world people wouldn't usually see. Most investors can't invest in alternative assets like hedge funds or private equity due to the accredited investor rule. This rule says that only people with a net worth of at least $1 million can invest. But this aspect of the market is an excellent way to diversify your portfolio, and shares of Blackstone provide you with the opportunity to invest in a business that owns those assets. In the first quarter of the year, sales were down 3%, but earnings were up 7%. This shows that the company is trying to find ways to make more money and protect cash flow. Even so, it could still be a hard year for the financial markets and these asset managers, but Blackstone has a history of success. Lastly, Ares Management, ticker ARES, also serves as an alternative asset management company like Blackstone, and it pays a dividend yield of 3.41%. However, Ares is much smaller than Blackstone, with only $325 billion in assets under management. With management for credit, real estate, and trading on the secondary market, now I like how big Blackstone is, but it's hard to argue with the development and return of Ares. Ares has shown that it can keep growing even when the market is bad. This graph shows how fee income has grown over time, even during hard times like 2007 to 2009 and the pandemic. Fee income grew by nearly 30% per year. In fact, when dividends are taken into account, Ares has given a total return of $285 over the past 5 years. Now, because Ares and Blackstone are so comparable, I don't suggest you have both in a portfolio. The choice is between size and growth. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching.